Halfords shares rose 13% on Thursday after reporting its highest gross margin in a decade. That sentence is startling only if you know what the stock was doing before Thursday. Over the prior 5 years, Halfords had shed 41% of its value, one of the longer-running underperformance records among UK mid-cap retailers. The market's read was consistent. Rising minimum wages, soaring national insurance costs, and a structurally squeezed UK consumer would compress margins at a retailer selling bikes and booking MOTs. Thursday's numbers directly confronted that read. Gross margin expanded 210 basis points to 52.8%, the highest level in 10 years, despite operating cost pressures the company had flagged throughout the year. The provisional answer is that the cost bottleneck the market treated as a structural ceiling turned out to be a temporary drag, not a permanent cap. Revenue grew 4.8% on a like-for-like basis to $1.80 billion. Underlying pre-tax profit climbed more than 8% to $41.5 million on a comparable basis. The company had swung from a $30 million reported loss in financial 2025 to a $43.6 million reported profit. What the 5-year chart priced as a fundamentals decline was partly an accounting artifact and partly a real cost squeeze that the business model, as it turned out, was capable of absorbing. The question the share price has not yet answered is whether this is the start of a re-rating or a single-year relief rally before a harder second half. The cost pressure Halfords faced entering financial 2026 was not abstract. Chief Executive Henry Birch put a number on it: £40 million in total cost inflation, of which $32 million came from wage-side pressures, minimum wage rises, national insurance increases, and the knock-on effect across pay scales. The conventional resolution would have been headcount reduction. Halfords did not cut jobs. Instead, it extracted margin improvement from a structural change to how revenue is generated per site. The Fusion Garage model, which co-locates a Halfords retail store with an auto center's workshop, is the mechanism. By the end of the financial year, more than 100 Fusion locations were operating, with 35 more planned for 2026. A customer visiting for a bike part can be converted to a tire check. A customer booking a service can be walked through retail. Auto Center's operating margin improved 50 basis points on this basis, and the Auto Center's division posted like-for-like growth of 5.8%, outpacing the retail arm's 4.1%. Return on capital employed rose from 12.6% to 14.2%. The buried assumption the market's bear thesis rested on was that labor cost inflation could only be offset by volume or price. The Fusion cross-sell showed a third path: higher revenue per customer visit without proportional labor additions. That is the mechanism the 5-year bear thesis did not include, and Thursday's margin figure is the first full-year evidence that it works at scale. Halfords' forward case rests on 2 structural developments that sit outside normal retail cycles. The first is EV servicing. The company has installed specialist EV servicing equipment in the majority of its auto centers and is training apprentices specifically in hybrid and electric vehicle maintenance. As the UK vehicle fleet gradually electrifies, independent garages face a capability gap. Halfords is positioning to fill it. The second is the staycation tendency. CEO Birch cited a growing trend for people holidaying in the UK as a direct sales tailwind. Roof boxes, roof racks, cycling accessories, and e-bikes all benefit from a consumer opting for a UK road trip over a foreign flight. E-bikes were described as a standout performer, with the company planning a significant expansion of electric mountain and hybrid bike ranges. The trap embedded in this forward story is timing. Halfords explicitly flagged that it has not yet seen any change in consumer behavior from the Iran conflict, but described itself as sensitive to potential impacts on spending in the second half of financial 2027. If oil prices remain elevated and household energy costs rise through the autumn, the consumer who drove the first half staycation spend may pull back. FY 2027 guidance, underlying profit at the top end of a $49 million consensus, is weighted towards the first half. That front-loading is both a strength, strong current trading in April, May, and June confirmed, and a risk.
Second half delivery depends on consumer sentiment holding in conditions that remain uncertain. The EV servicing build-out is a multi-year structural play. The staycation tailwind is weather and geopolitics sensitive. These are not the same duration of bet, and the share price today does not distinguish between them.
The counter evidence against a full re-rating is not trivial. Free cash flow for the year was £25.3 million. Positive, but modest relative to the $1.8 billion revenue base. The 5-year total shareholder return, even including dividends, remains negative at negative 25%. And while guidance is for the top end of the $49 million consensus, that guidance carries an explicit caveat on second-half consumer confidence. The near-term risk that directly tests the thesis is not an earnings number. It is whether Fusion's site-level returns sustain their 50 basis point margin improvement as the rollout scales from 100 to 150 locations. A rollout that worked at 100 sites under tight execution discipline does not automatically hold at 150 if site quality and management bandwidth thin out. For a holder of Halfords who has endured 5 years of underperformance, the question is whether Thursday's result represents the proof of concept that justifies holding through the second half, or a relief event to exit into. The answer is not yet in the data. The first half FY 2027 result, expected around November 2026, is the genuine discriminator. It will confirm whether second half consumer caution visibly hit auto centers bookings or whether the service model buffered the shock. For a watcher considering entry after a 13% single-day move, the variable to track is Fusion per-site revenue density, not headline like-for-like. A business that absorbed $40 million of inflation through cross-sell efficiency, not volume, will pass or fail on whether that efficiency holds as the network expands. The November interim result is the first clean read of whether the decade-high margin was a structural shift or a single-year compression release. That is the threshold that decides whether Thursday was a turning point or a trough bounce. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.